All right, we're opening the C-suite. I'm Mike, Corey, and I'll set the stage for today. We're talking about the first board meeting after the financing. Now, at different stages of companies, Corey's been, PE-backed CEO. I've been startup, ground flooring up, and so it's different at different stages, right? We could be talking about, the early Series A, Series B fundraising. We could be talking about a private equity buyout, an acquisition. But what's interesting here is that as the operators, we can get into this mode where the hill to be climbed is to get to that moment of the financing, especially early stage startup, I'd say, from my perspective. And there's a lot of emphasis on the valuation of that deal. Coming from my world, you want to get to a high valuation,
even if you're going public.
There's
a big focus.
Everybody wants to get there, right? And if you're going public, obviously it's a lot of shareholder payout and everything, so there's logic to it. There's logic to the startup. But as the operator in the seat, whether CEO or anywhere in the C-suite, now you have the first meeting after that financing, and depending on the dynamics of it,
First board meeting.
Depending on the dynamics of that deal, really high valuation comes with really high expectations. We're going to talk about the first meeting after, which can be sometimes not thought about as much when you're pursuing the financing, right? So let me ask you this. The first meeting, you've been on the board, you've been the operator. How often is it going well according to plan? How often is it a little behind because the numbers were inflated? Like, what tends to happen here?
It's usually a little behind.
Little behind? Okay.
I mean, look, there are absolutely situations where everything is great and there's not a single problem in the world. But let's remember, every time you're raising money in any way, shape, or form, including going public, you are telling the best possible story that you can about your company. And as a result, you are probably pushing to the limit, so the littlest wiggle in anything is going to bring challenges. It's not to say some companies don't walk into that first meeting and things look great. That absolutely happens. But that doesn't, there's probably something a little askew from what was sold, so to speak.
All right, so let's do a little, myth busting or clarification. From the investor standpoint, is that expected? Is that okay? Or what you pitch on, is that what you're held to?
You're held to what you pitched on.
Okay.
You are held to, if you pitched it, you're held to it.
Okay, now as a founder, I've also heard this though. Hey, they're going to discount the numbers you show them anyways. What does that mean?
That's how they price the deal. That's how they expect what to invest in.
Okay.
You're right. If I'm looking at a deal and they show me a plan, I say, okay, so if they hit X, Y, Z numbers, they came down 10%, they came down 15%, and we invested these dollars, and then you roll that forward, here's how it plays out. Okay, I can still hold this valuation.
Right, so there's an underwriting process.
Yes.
Then there's a management process.
And I'm looking and I'm discounting for the underwriting process. I'm walking
not
in.
for the expectations.
I'm holding you to your plan.
Sure. Yeah. So that's a tricky thing, right? Because also, there's two sides of it, right? Like obviously the operators, whether it's founders, CEOs, a later stage company, you have a lot of stakeholders that you're fighting for, right? So you want to get the best economics. The investor side, I think there's also a little bit of, if you're asking every pitch for what is the story of how it gets to this $1 billion thing, that's what you're going to receive. And I know a lot of founders, everybody's kind of trying to figure out how to draw a unicorn somewhere in the deck. And so I think in some ways that's self-manifesting, that you're going to get kind of aggressive pictures in the deck. So how do we get to like a balance point where that first meeting can go well?
A relationship with those investors. And look, it's a little different on the public side, right? While I didn't take a company public, I was at a company that we did a massive acquisition, bought a company more than double our size, and it was pretty much the equivalent of your first board meeting after financing, right? And so what are you going to tell them to look for? What should they be watching? The relationship you have with an investor is going to dictate how much flexibility you have to work with. And I'm going to go even further and say, how much time did you invest in being honest and building credibility with that investor?
In the due diligence process.
In the due diligence process. And look, on the public side, it's not like you're not talking to the possible, big institutional needs that are going to be on your back later. How do you build credibility with those organizations? And I'm a believer in transparency, But transparency also can go too far when doing a financing. So as much as you can tell them, keeping it as clear as you can, making sure that the things you're sharing now are the right things they should be watching for later.
Okay.
We're going to make progress in Europe next year with operations. Is that real, or is that just because you think that's a bigger total available market and you want to be excited?
Yeah.
If you're going to communicate it, you expect to be held to it later.
Yeah. Now, how do you communicate because there is some degree of having to show here's what could happen. How do you define what I'm talking about as could happen versus I'm saying this is going to happen?
And it is, once again, it's that. You just nailed it, right? It's like, this is our plan. If we do this, we could do that. If we do this, we could do that.
Yeah.
The optimistic plan doesn't happen without some action.
Yeah.
Right? Have you ever seen an optimistic plan that didn't mean I have to hire a new salesperson, I have to have a product?
Yeah.
Right? So what's the cause effect?
Right.
Be clear what if we do this, that happens. And you walk in and go, didn't happen, so that upside isn't happening.
Yeah.
Well,
and on that point, something that I found was so important for me in board meetings was being able to define what was the shot or the swing that we were taking.
Yep.
Hoping in a hypothesis to get to this next thing. Now, if that's core to the foundational P&L, that's problematic. But if it's, hey, here's how we think we take the next leap, and being able to look back and say, we did take that shot. Yep. Here's what went different than what we thought.
Yep.
Now I feel like I'm in a pretty good place. But if it was like, I don't know.
Yeah,
I don't even know what shot we took.
Yeah.
That's tough.
And let's be clear. When you're raising money, you're dreaming. Right? You should be dreaming. You should be dreaming with the investors. Here's what it could be. Here's why we are going to be enormous. I don't care if we started at $1 billion. You're investing because we're going to be $20 billion.
Yeah,
if you're $1 million, it's because we're going to be $1 billion, right? It's a dream. What gets you there to the dream?
Yeah.
Communicating that. Too many companies make the mistake of just focusing on the financials. If I drive to the future and here's just my financials, and you're not working with that investor through the process and letting them know how I get there, what I have to do, what's it going to look like, and sitting down and having, when you're raising money from VCs, PE firms, having dinner with them matters.
Yeah, okay.
Build a rapport.
Yeah. How do you get the time? So sometimes it's hard. In this async world too,
Absolutely.
It's like, it sounds great to have a few dinners, but if time is scarce, how do you approach that?
Well, and maybe it's not sitting down and having a glass of wine.
Yeah, okay.
But
that would be ideal, if you can do it.
A glass of wine before the investment is a good thing to do.
Really? Okay. All right.
So, but I would say
let's stay on that with the wine guys.
Yeah.
What's different about having the glass of wine versus a cup of coffee?
A cup of coffee tends to be a timed meeting. We're in and out.
Okay.
We're trying to get through it. And, a cup of coffee is we're going to catch you in the morning before our meetings begin.
Yeah.
Or I got time this afternoon. Let's squeeze it in. Sitting down, when you're sitting there having a glass, you're now relaxing, and time moves at a little different pace. Now the conversation's more organic.
All right.
It's not on the clock, and you're getting to know each other. Because, look, at the end of the day, that first board meeting is about trust.
Right.
What trust have you built in them through the process, and how are you building more trust today?
Yeah. So let's say I managed to get the future board member investor to sit down for wine with me.
Yeah.
What questions should I be asking?
How do they see the business? What do they think of their drivers for growth? What are the areas that concern them about what you've shared?
Yeah.
When have they seen this before? How have they helped firms, companies do this?
Yeah.
What are their model returns?
Yeah.
What should they have? Once again, I go to the public side, going to say, what are the model returns your fund needs?
Yeah, right.
Just as important to go into a VC or a PE firm.
Yeah. Now that's something I think at the earliest stage, from a founder standpoint, what are the dynamics of what your fund needs? That's not even a question that comes to our mind.
That's right.
I know what I need. I don't care what your
Did
fund
that matter to you later?
Well, yeah, that doesn't matter because now all of a sudden, you're going, let's say you get past the point of like early product market fit, and it's like, all right, what are the routes that we take? You can be in situations, I'm sure you've seen this more than me, where across a board, everybody has potentially even a different scoreboard that you're competing against. And so, knowing it's so easy, especially for us, we were young founders too. We were 21, 22.
Yeah.
And you just view it like, well, the investor is just this king of their own universe.
That's right.
But in many cases, they have their own stakeholders, right? So it's not like it's their fault. They've got their own, bosses per se.
Yeah.
So it's this big ecosystem that everybody has a role in.
Yeah.
And understanding beyond our isolated startup, what gear we're moving for somebody else is important, but sometimes hard to also understand.
Yeah. And look, good news is typically when you go to that first board meeting after you do some sort of a fundraising event, everybody's on the same page. Everybody's in the same time horizon.
Yeah, sure.
For the first one. For the second one,
right.
it's a little different because you probably brought a new party to the table.
Yeah.
And that new party has a different timeline and different return horizon. And the old parties, they probably already made some money on it, or, and so on. So, and also it gets more complicated as the CEO to manage the dynamics of each of the investors' requirements, timelines, how they operate, and so on.
Yep.
Right. But I mean, let's go through the number one thing of all this communication, all this data. It is all about trust.
Yeah.
At the end of the day, if they don't trust you as the executive, nothing matters.
Yeah.
And so I know some executives are like, I'm really good at dancing and I can tap all over. Don't do it.
Yeah.
Don't go in there and just spill garbage.
Yeah. For your own sake, don't do it. Because now you're...
But for your own sake, go in there and say, here's what's going on. The more transparency. Now, transparency doesn't mean putting it out there with no explanation, no understanding, and no actions.
Yeah.
If you get something bad, here's why it went bad. Here's the actions we're taking to deal with it. Bad news travels fast. Make sure if it's bad, they know. But they know.
First agenda point in the meeting, or do you build the context to it?
I usually put up front with quick context.
Quick context. Okay.
Got to share with you, here's what we're seeing. It's going to result in this. Let me take you through it. But what I'm taking you through is not just what happened, why we think it happened, what actions we're taking to correct it.
Yep.
Don't make them say, what are you going to do? Because they're going to ask that, damn it, you know it.
Now, I can recall in my experience, and with you on the board, two versions of this. One where I went in, okay, well, the board meeting's in a week and they're going to find this out. Okay. And even if I brought it up first thing, now it's, me with the, the Shark Tank panel. Another version, as I got, a little wiser, was you get a call from me, one-on-one, right?
Mm-hmm.
As does, Troy and Jamie, whoever's on our board. And it doesn't mean you're happy about the news, but now, we've been able to digest it one-to-one, and the thoughts that I have for how we course correct, you've been able to opine on that. And now as we get to the meeting, there actually is no news to travel fast. It's already gone.
That's right.
And so now we're actually rolling our sleeves up. That was a way easier board meeting than when I came and said bad news, and you're like, what the F?
You made a really important point there. It wasn't just a call, but it was also the what do I think and what actions are we going to take? And you would always say, well, we're going to talk more about it in the board meeting, but here's what our initial thoughts are. We're still working it.
Yeah.
We'll tell you what else we're going to learn and what else we have decided to do. Yeah. But you didn't just come and say, bad news, this is a mess, later,
right.
and hang up.
Yeah, now the internal side of that too had two versions of, you've probably seen us as an exec team, founder team in the meeting. Certainly you want to roll up your sleeves and be thinking through things, but if it's still fresh to us and we're coming to our ideas versus we've had an internal meeting and we have digested and come up with some of those plans ourselves.
Yep.
That I think has to happen along with the CEO's one-on-one calls.
Yeah. So what we're saying is, if you get to a fundraising event, you get to some sort of big financial event, that first board meeting, first off, you're setting the tone for transparency. You're setting the tone for trust. You're setting the tone for how you're going to operate here on out. So walk into that knowing what metrics you want them to be looking at, what are the most important things they should be thinking about, help guide the board as to how to interact with you. We recommend you be as transparent as practical.
Yep.
And if it's bad news, don't wait for the board meeting for it to come out.
Yep.
Preview it, talk to people in advance. But if you're walking with bad news, walk in with why we think it happened and how we think we're going to resolve it, what actions we're going to take, and we're here to hear more from you.
Yeah, and wrapping it up with what the theme of this was, that first meeting after the financing, having that in mind through the financing, because it's not we don't care what you said, we're here cutting it anyways. That's for the underwriting process. The expectations are what's been communicated.
Absolutely.
And so that's preparing for the first meeting after the financing.
Thanks.